Hi there everyone, welcome to a special episode of Market Intel, the show that tells you what's actually happening in the SME world. Today my co-host is Ian Morkel from Kendon's Chartered Accountants and Advisors. How are you, Ian?
Yeah, g'day. Doing well, thanks. Just busy trying to help everyone out with their wage subsidies and that sort of thing at the moment.
And today's special guest is Tony Alexander. So if anyone doesn't know who Tony is, he's one of New Zealand's leading economists, former chief economist at the DNZ. And how long have you been an economist for, Tony?
Oh, let's see. I graduated at the end of '84, a couple of years in Sydney with Westpac, back to New Zealand with Westpac just before the share market crash in '87. So started as a research economist, I guess, back in Sydney in about '85, but not really a proper economist until maybe about 1988 or so. So whatever that adds up to, 3 decades or such.
Yeah, nice. Well, I was born in '88, so there you go.
Just a nipper.
So you've obviously been for a few market events, shall we say, which probably leads in perfectly to the whole point of today's conversation. Normally we talk about the challenges and opportunities in the SME market, but obviously there's certain things happening at the moment, so hence why we thought it'd be brilliant to get you on board and get your view on what's happening. And because when you listen to the media, it can obviously be sort of twisted in a certain way. So actually listen to someone from a high level looking at the numbers and has been here before and understanding. So I guess my first question would be, how bad is this actually going to get? Is this the same as the GFC, or is it potentially going to be worse?
Yeah, well, that's the interesting thing. People are bandying numbers about at the moment, and they're scary in terms of where might the unemployment rate go in New Zealand or the United States, Australia. How much might the economy shrink? And we got the ANZ's business survey numbers the other day, and they're truly appalling as well. My advice to people is do not look at these numbers because they don't have the relevance, the significance that we would normally attach to them. So if we weren't having a virus, if this was just some sort of a normal economic downturn and you saw the numbers you're seeing now, I would be worried. We would all be legitimately concerned about things. And the reason we worry is because not that the numbers look bad, but what the numbers mean is going to be happening with our families, our businesses. We know that if you get the unemployment rate shooting up, it means that people are going to not be able to pay their rent, they're going to get evicted. If you've got business profitability disappearing, businesses are going to be closing down holus bolus. You know that banks are going to be pulling back on their lending, they're going to be calling in loans, you're probably going to get mortgagee sales, so the house prices fall away. And that's where this event is unique in the economic history of the entire planet. Now, the lesson of the Great Depression was don't cause it. When you have a fall in your share market, don't tighten your money supply. Don't allow half your banks to fail, as happened in the United States in the 1930s. Don't raise your taxes, cut your spending with the government to try and balance your accounts. And ever since the Great Depression, through Keynesian economics, we've seen the opposite happen. Interest rates go down, liquidity in the system, governments run deficits. And we saw that in spades with the global financial crisis of 10 or so years ago. So that's all fine. What this response to the crisis is about attacking what would be the second round impacts. We know it's all going to be bad. We know cash flows are going to be completely absent for many businesses for a period of time. Let's stop the second round impacts. So how do you stop a surge in mortgagee sales and collapse in house prices there, for instance? Number one, you give the 6 months mortgage holiday so people can buy time till their circumstances are better down the track. How do you make banks not aggressively start pulling loans in because they're worried about their situation? You set up a $6.5 million government guaranteed finance scheme. So the government takes 80% of the any loss that may accrue to the extra money a bank is extending a business to get itself through to the other side. How do you stop people getting out on the streets there? You basically ban evictions for a while. And we've seen different versions of these things, and their ultimate aim, this is now openly talked about overseas, but it sort of started here in New Zealand. It's basically to put your economy into hibernation, into a deep sleep, stop these second round impacts as best as you can, and move the economy through time to the recovery on the other side. Now, for New Zealand, this recovery is probably going to come sooner. than in other countries, because there's a very good chance where our 4 to 8 weeks lockdown will get rid of the virus in New Zealand, and then we can start re-engaging the hospitality sector, that sort of thing coming up. Overseas, I think they might have to wait till a vaccine, maybe that's 12, 16 or so months away. It's not the GFC. That was the GFC. It's not the GFC because that was a banking crisis. The credit market seized up. That's not what this is about at all. The banks have gone in around the world with good capital levels, without the bad lending, and particularly in New Zealand, the growth over the past 5 years in borrowing by households and by businesses is half the growth that it was in the 5 years into the GFC. And in the farming sector, here's the big one. In the 5 years going into the GFC, debt for farmers in New Zealand grew by 111%. Past 5 years, it's only 20%. So we've sort of gone into this in a relatively good shape. We're not facing a collapse in commodity prices. We're not facing soaring oil prices. We're not having a massive housing crunch because the mortgage rates were at 18.5% of 1987 or so, or the 11% of 98 Asian crisis, or 08, the GFC. The low interest rates are a big insulator. So it's bad, but a lot of this is, the badness is at a point in time. It's heavily front loaded, the job losses. So you're going to see ugly numbers for the next few weeks and months. Don't pay a lot of attention to them because they don't have the same significance on duration of weakness as past downturns.
Nice. And so, like you're saying, obviously it's been a fantastic package that the government sort of responded with to help businesses get through. Say we are in lockdown though for, say, 8 weeks or longer. Do you think the government has enough money in the coffers to keep that stimulus going?
Okay, it's not a stimulus. It's no good actually giving them, you and I, extra money to spend. We can't spend it. So that's where this is unique. We're used to thinking of, there is a downturn with Keynesian economics, the government will look to stimulate the economy. That's pointless. Their measures are aimed at carrying as many jobs, as many businesses through in time. And if the cost of doing that, rises above what they're already paying in order to do that, well, New Zealand has, significant fiscal reserves to do that. And of course, there is the quantitative easing sort of injecting extra money out there as well, where essentially the Reserve Bank finances the Treasury, the New Zealand government. So I think there's a lot of funds available in New Zealand that can be called on, but what you have to realise is it's going to mean higher taxes in the future. And it's going to be for the government to decide over what time period do they get the accounts back into shape. Does it mean an increase in GST rate? Does it mean higher income tax rates, or all of those sort of things? But that's all down the track. No point talking about that now. It's really just about getting people through. So now there is more that they can do if need be, if it goes on for longer.
When we come out of hibernation, I don't imagine we're all going to hop in the car and go down to Westfield or to the pub and carry on. What industries or businesses ideally would start up which would to benefit the economy the most, or to save the government the most money in terms of the sort of propping everyone up while we're in pause?
Yeah, okay. If you look, for instance, starting out with obviously the international tourism market, that's gone. Got to say that completely. That is gone. There is no sector there. So that's 165,000 direct and indirect jobs that are gone there. And there's going to be a lot of pain in your likes of Rotorua and Queenstown. And so we can't really talk about a recovery in that until 2021, 2022, many years in the future. The hospitality sector, obviously it's not functioning at the moment. There are a lot of businesses that are going to get burnt off. There are so many small operators there. They won't get through to the other side, quite frankly. But once we are free, we are going to be wanting to, as the social distancing rules initially get reimposed, but then slowly eased over time, we're going to go back to the bars. We're going to, I think, go back and want to socialise with each other. So I think the recovery in the hospitality sector, it pretty much starts straight away. There's a lot of other sectors out there where there's underlying strong growth over the past few years and expected for the future. So in some regards, they were having a downturn at the moment through lack of workers, etc., but they will be regaining their previous upward trend. So in no particular order of importance, the developing space industry in New Zealand worth about $1.7 billion at the moment. The wine industry, subject to maybe the number of bottles building up for a while because the restaurants are closed, etc. Overseas. The pip fruit sector, so your apples, kiwi fruit sector. People obviously more interested in eating healthy food around the world, so that's a good thing for them. New growth, I would suggest, in maybe your sheep and beef sector. The world is worried about food availability, so I would expect greater interest in New Zealand's production of food over the long term, and I would expect to see more capital not going into the tourism sector. Now the capital is going to go into the broadly defined primary sector, aquaculture, seafood, etc., included in there as well. Underlying strong growth in the renewables sector, medical technology sector as well. Healthcare, everything related to that, likely to be showing some fairly strong growth going forward. Aged care, underlying strong growth there as well. And so often when we have a recession, people think everybody's stuffed, everybody's munted. Not the case at all. Some sectors are probably better off as a result of this because they get a lower exchange rate, they get greater labour availability, they get even lower interest rates, your primary sector. And so that will become a larger proportion of New Zealand's export base. It already is now with the absence of the tourists, but I would expect more, I would expect the government to ease off on some of their anti-farming stuff over the next wee while, because that is the sector we're going to be relying upon, as we always have in New Zealand's entire economic history, to generate the export earnings.
Another question I've got is, the NZX got battered black and blue and this all sort of kicked off, and what do you think will happen in regards to the sort of equities market and the housing market? Will everyone be taking their money out of the stock exchange and shoving it back into good old bricks and mortar? What's your view on that?
Yeah, not so much. I mean, I've made a comment in some of my publications that now the young people understand why the baby boomers have had a preference for property, because the baby boomers and generation after them saw the share market collapse late 1987. The economy was then in recession largely for 4 years afterwards. But back then, the New Zealand share market over a period of 4 to 5 months fell 60%. We're only down about 25 or 20% or so now. We're back to where we were either late 2018, early 2019. So definitely a shock for a lot of people who were starting to feel really clever because of the 30% gain in our index previously up until about February. But no, I don't think we're going to see a big switch, but I think because of that, just the volatility we know can happen just about any time in the share market, some people will move towards a preference for, and I would say here, residential property. The interesting trend recently has been the trend towards people saying, oh, residential property is so hard, the government hates us, I'm going to go into commercial property because that's easy. Those of us who've been around long enough sort of stifle our laugh on this one, because it's a sector which is not easy. It can give really good returns, but people have to go in with their eyes open to the tenancy risk. And I'm finding out there's possibly a bit more analysis behind the scenes going on with regard to what this means for the commercial property sector than actually the housing sector. Most of us are saying the housing fundamentals, by and large, are unchanged long term. That's not the case when we're talking about office CBDs, because the need for such a volume of space is clearly going to be declining there. So that's probably likely to catch some operators out there. And of course, in the tourism sector, all the facilities that have massively expanded there, I think we've just had a lot of extra hotels being built and coming on stream. We already knew about this year. Clearly, that's a sector that's going to go through a correction, and maybe we're going to see some of those, if they can, be converted to residential accommodation. But again, on that side, student accommodation. The students, they're either not here now or they're not going to be here for the rest of the year. And so there's going to be an oversupply in that particular market. So Auckland inner city is going to be a very interesting market, hard to get a grip on the residential and commercial side for a decent period of time.
No, it sounds like it's going to be quite interesting. And the access to capital in general for property developments and investors was getting harder anyway. But it sounds like it might even tighten up a bit more as probably more of those sort of second and third tier private lenders probably exit the market.
Yeah. It's not just that. Yeah, it's not just what we can already see. The new non-bank lenders, let's say in the residential that were coming into New Zealand and expanding aggressively in recent months, that they're heading back to Australia. I guess they retain some presence in New Zealand, but like everybody, you've got to consolidate on your home base. The other issue, however, is for the banks. Now, we already know the banks tightened up on, let's say, commercial residential property development in the early 1990s. The finance companies took over. They tightened up further after the global financial crisis, reducing the riskiness of their lending, building up capital bases, all that sort of thing. Where people like me have been warning that going forward, banks would pull back even a bit further from property development because of the riskiness and the need to hold even more capital for these activities going forward. Now there's a whole new thing. Banks for the moment are completely busy with servicing their existing client base. That's why I emphasised right at the start, this isn't about stimulating the economy for maybe the remainder of this year. It's about getting as many of your existing clients, tenants, work positions through to the recovery on the other side, to at least seeing the light at the end of the tunnel. Banks are simply not going to have the staffing resources, let alone the risk appetite to be taking on many new business loan applications in this environment. So stuff which people might have had about to sort of come off the drawing board and got the keen sense, and we're trying to maybe solidify on the bank finance, a lot of that's simply not going to happen in the next year. Then when the banks have resources freed up and can start considering these things a bit more, there's still going to be a structural reduction in their willingness to lend because they've got to rebuild their books. They are going to suffer a lot of losses from a great range of clients quite clearly over the next 12 months. And so this to me is another structural reduction in bank willingness to take on risk. First one was after the boom in the lending of 84 or 87. Another one was post-GFC. This is going to be another one as well. And it means that anyone contemplating any sort of, even for your average business out there, they're going to have to think more about financing growth through retained earnings and bringing in outside capital, which is always a challenge for New Zealand business owners, especially in the SME sector. We don't like losing some sort of control by having a new investor come in. It'll be interesting to see if the Chinese banks maybe get a wee bit more, I don't know about aggressive, but start making some more funding available. I haven't really got a feel for that.
And so, Ian, you're saying that your clients are obviously all a little bit nervous at the moment. What's the trend you've seen in the last couple of weeks since we've gone into lockdown and this is all sort of kicked off? What are people most worried about that Tony might be able to shed some light on?
Well, I think being Canterbury-based, people sort of have had a similar event, and I think that's almost given a lot of business owners a false sense of security. So you've sort of been through this before, but but the last time we had a lot of insurance payouts coming out for assets or for business interruption. There's none of that now, and I don't think people have got their head around the fact that they need to have a plan or a strategy in place for coming out of lockdown. It's probably going to be some sort of ease back or gradual exit out of lockdown and start trading up gradually, or find new distribution channels or new ways of doing it. And for a lot of them, they actually have to start this planning now to actually wind up, because a lot of them are going to have to stop and start again. Especially if you're in hospitality, like Tony said. So for me, I think there's a bit of a head in the sand situation, which is with clients or businesses, because the wage subsidy is doing what it should do. It's giving you money, it's giving you a bit of security. You can pause, but not enough people are thinking ahead. There's an article this morning in the press about a market gardener who's got his field full of vegetables and he can't sell it and it's going to rot in the field because his normal distribution channels are blocked, because the supermarkets are the only one selling those goods at the moment, and they aren't necessarily buying from him. So I think overall, I think there needs to be a focus on supporting local or New Zealand businesses, and that's going to start helping people sort of drive a bit more sort of positivity into things. But for most of them, I genuinely feel that because they're not planning or thinking about it, they actually don't have a way forward, and by the time Easter runs by or Anzac comes by, we'll see a lot more panic in the market.
Yeah, what I've been saying to people out there is that this is the best opportunity they will have ever had and will probably ever have to work on their business as opposed to in their business. And not just because of the pressures of this particular event. My message in my talks for the past 2, maybe almost out to 3 years, is that we're going to have, and I figured starting this year, so I sort of got the year right, but I figured we'd have about 3 years of what I was calling a weeding out period, when a lot of companies who had not adapted to the big changes in their operating environments were going to have to make those changes. And so obviously didn't anticipate this virus thing, but I've been saying to people in my talks around the country, you've got decreasing ability to maintain your margins because your pricing power has gone. We consumers can all go online and at zero cost find an alternative supplier of a product. You put your prices up on me, I'm going elsewhere. So I've been saying on the basis of that, you really need to look at where you've got some pricing power, if any, and if you haven't, you're going to have to be looking at where do I make the most money in terms of the location of my sales, the products themselves, the type of client. So get a bit sort of hard-headed on rationalising things, especially in an environment of new resource constraints. The big one I used to talk about was shortage of labour. That's here at the moment for the lockdown, but once the lockdown ends, that one I think is pretty much on the back burner there. But the other constraint I've already mentioned, and that's of bank finance. In New Zealand, outside of the United States, in the Western world generally, we largely finance our business growth with bank credit, essentially. In the US, it's more actual investment money, capital. And as the banks are going to tighten up further down the track there, businesses need to take into account, if I grow my business, it's got to be at a slower pace, retained earnings, or bringing in some new capital. And that could easily come from overseas, because we know investors these days are looking at the whole planet for where they can find these sort of investment opportunities. I've also been saying this weeding out process where you've got to rejig your business is also going to be driven by social pressures. So what are you doing about climate change? What are you doing about use of plastics, etc.? It used to just be, don't use slave labour, don't have a lot of pollution coming out of your chimney going into the sky or into the local river. Now businesses have to think of a lot of extra things. They also have to be thinking about inundation risk. So are my facilities located near a river? Am I near the coast? For investors, the same thing. Because with global warming, you don't necessarily get more rain falling, but you get it in a shorter, more intense sort of period of time, or at least bigger rain event. So the rivers overflow and change course as they've always done, and the sea level rising and more big waves coming in. So that's another thing businesses also have to take into account. So I think I ended up with sort of a list of about 4 to 6 things of these were the pressures coming along. I even warned about the tourism sector. We've had a boom. You cannot expect that we'd have another 70% increase in visitor spending here as we had between 2014 into sort of 2018 into 2019. It was always going to at least plateau. Now it's gone completely, so definitely didn't pick that one. But yeah, businesses are going to have to get their blinkers off, because much as the government's trying to carry the economy through, the world has changed, and the sooner you realise that and alter not just your cost base, but also what you're producing, how you do it, who you sell it to, how you sell it. The sooner you make these sort of changes, the better you'll be positioned for the normal growth, which will eventually return. It won't be normal this year, but we can talk a bit more about normality returning in 2021.
Nice. So just to wrap up, because I know you've got some other stuff you've got to get on with today, but we always finish off our Market Intel interview with one piece of advice. So I guess from you, the way I can summarize this sort of chat we've had today is, everything you hear on the media, take with a grain of salt. It's not as bad as people are sort of putting it out there. We will get through, and we've got the government's got the balance sheet to actually help us get through, as long as we're smart about it and, like you say, open our eyes that it's going to be a different world moving forward. So for me, the biggest thing, I guess, is from your piece of advice is, how can a business owner lift their confidence? What's your one piece of advice to, when this is all done, getting out there? Is it going in with a mindset of let's just get in here and get it done, or is it going to be more be a bit more cautious?
take charge and change early. Don't be thinking that the world on the other side is going to be the same as it was 3, 6, 9 months ago. It was always going to change. That was my message with the weeding out, process. The weeding out I thought would take 3 years. It's going to get done in its entirety this year. So get stuck into what you do, how you do it, who you liaise with, what your partnerships are. You've got an amazing period of remaining 3 to 7 weeks now to get your firm in decent shape for the future. So take charge of what you can control. There's a lot out there you're simply not going to be able to control going forward. And if your business is completely unviable, well then, call an end to it as soon as possible rather than, burning out cash in the future. Preserve what you can and recognize that just as we saw in my own family in the 1970s, a lot of people are going to be losing their businesses. They are going to lose their houses, but it's an economy in which the opportunities to do things are far greater than anything we've seen before. Kids coming out of school and university these days face a range of employment opportunities, massive compared with us that exited in the 70s or myself in 84. So the world is still people's oyster. You just can't go overseas and eat it for a while, I would suggest.
No, sounds good. Thanks, Tony. Always great to hear from you. And Ian, any last comments you want to put in there before we finish off today?
Just start planning now. Plan or start your new improved business now. That's it in a nutshell.
Awesome. Thanks, guys. That's it, episode, everyone. If anyone wants to follow up with any of us, just flick me a message and we'll take it from there. Cheers.
Right. Cheers.
Thank you.